Well, first and foremost, Happy New Year to all of you, friends. And now I can proceed with our statement, the introductory statement. Ladies and gentlemen, Vice President and I are very pleased to welcome you to our press conference. Let me wish you all a Happy New Year, which is I've done. I would also like to take this opportunity to welcome Latvia as the 18th country to adopt the euro as its currency. Accordingly, Mr. Rimšēvić, the governor of Latvia's bank, became a member of the Governing Council on January 1st, 2014. We will now report on the outcome of today's meeting of the Governing Council. Based on our regular economic and monetary analysis, we decided to keep the key ECB interest rates unchanged. Incoming information and analysis have continued to confirm our previous assessment. Underlying price pressures in the euro area are expected to remain subdued over the medium term. In keeping with this picture, monetary and credit dynamics remain subdued. At the same time, inflation expectations for the euro area over the medium to long term are firmly anchored, in line with our aim of maintaining inflation rates below but close to 2%. Such a constellation continues to suggest that we may experience a prolonged period of low inflation, to be followed by a gradual upward movement towards inflation rates below but close to 2% later on. Against this background, the Governing Council strongly emphasizes that it will maintain an accommodative stance on monetary policy for as long as necessary, which will assist the gradual economic recovery in the euro area. Accordingly, we firmly reiterate our forward guidance that we continue to expect the key ECB interest rates to remain at present or lower levels for an extended period of time. As previously stated, this expectation is based on an overall subdued outlook for inflation extending into the medium term, given the broad-based weakness of the economy and subdued monetary dynamics. With regard to money market conditions and their potential impact on our monetary policy stance, we are monitoring developments closely and are ready to consider all available instruments. Overall, we remain determined to maintain the high degree of monetary accommodation and to take further decisive action if required. Let me now explain our assessment in greater detail, starting with the economic analysis. Real GDP in the euro area rose by 0.1% quarter-on-quarter in the third quarter of 2013, following an increase of 0.3% in the second quarter. While developments in industrial production data for October point to a weak start to the fourth quarter, survey-based confidence indicators up to December have improved further from low levels, overall indicating a continuation of the gradual recovery in economic activity. Looking at 2014 and 2015, output is expected to recover at a slow pace. In particular, owing to some improvement in domestic demand, supported by the accommodative monetary policy stance. Euro area economic activity should, in addition, benefit from a gradual strengthening of demand for exports. Furthermore, the overall improvements in financial markets seen since the summer of 2012 appear to be working their way through to the real economy, as should the progress made in fiscal consolidation. In addition, real incomes have benefited recently from lower energy price inflation. At the same time, unemployment in the euro area remains high, and the necessary balance sheet adjustments in the public and the private sector will continue to weigh on economic activity. The risks surrounding the economic outlook for the euro area continue to be on the downside. Developments in global money and financial market conditions and related uncertainties may have the potential to negatively affect economic conditions. Other downside risks include higher commodity prices, weaker than expected domestic demand and export growth, and slow or insufficient implementation of structural reforms in euro area countries. According to Eurostat's flash estimate, euro area annual HICP inflation was 0.8% in December 2013, compared with 0.9% in November. This outcome was broadly as expected and reflected lower services price inflation. On the basis of prevailing futures prices for energy, annual inflation rates are expected to remain at around current levels in the coming months. Over the medium term, underlying price pressures in the euro area are expected to remain subdued. At the same time, inflation expectations for the euro area over the medium to long term continue to be firmly anchored in line with our aim to maintaining inflation rates below but close to 2%. The risks to the outlook for price developments continue to be seen as broadly balanced over the medium term, with upside risks relating to higher commodity prices and stronger than expected increases in administered prices and indirect taxes, and downside risks stemming from weaker than expected economic activity. Turning to the monetary analysis, data for November support the assessment of continued subdued underlying growth in broad money and credit. Annual growth in M3 was broadly unchanged at 1.5% in November after 1.4% in October, following two consecutive declines in September and August. Annual growth in M1 remained strong at 6.5%, reflecting a preference for liquidity, although it was below the peak of 8.7% observed in April 2013. As in previous months, the main factor supporting annual M3 growth was an increase in the MFI net external asset position, which continued to reflect the increased interest of international investors in euro area assets. The annual rate of change of loans to the private sector remained weak. The annual growth rate of loans to households stood at 0.3% in November, broadly unchanged since the beginning of 2013. But the annual rate of change of loans to non-financial corporations was minus 3.1% in November, following minus 3% in October. Overall, weak loan dynamics for non-financial corporations continue to reflect their lagged relationship with the business cycle, credit risk, and the ongoing adjustment of financial and non-financial sector balance sheets. Since the summer of 2012, substantial progress has been made in improving the funding conditions of banks. In order to ensure an adequate transmission of monetary policy to the financing conditions in euro area countries, it is essential that the fragmentation of euro area credit markets declines further, and that the resilience of banks is strengthened where needed. The forthcoming comprehensive assessment by the ECB will further support this confidence-building process. It will enhance the quality of information available on the condition of banks and result in the identification and implementation of necessary corrective actions. A timely implementation of further steps to establish a banking union will help to restore confidence in the financial system. To sum up, the economic analysis indicates that we may experience a prolonged period of low inflation, to be followed by a gradual upward movement towards inflation rates below but close to 2% later on. A cross-check with the signals from the monetary analysis confirms this picture. As regards fiscal policies, it is important not to unravel past efforts, but to sustain fiscal consolidation over the medium term. Fiscal strategies should be in line with the fiscal compact and should ensure a growth-friendly composition of consolidation which combines improving the quality and efficiency of public services with minimizing distortionary effects of taxation. When accompanied by the decisive implementation of structural reforms, this will further support the gradual economic recovery in the euro area and have a positive impact on public finances. Reforms in the product and labor markets and a rigorous enactment of single market policies warrant particular focus to improve the outlook for economic growth and to foster job creation in an environment of high unemployment. We are now at your disposal for questions.
Johanna Trick, Market News.
Johanna Trick, MNI. Thank you very much. Mr. Draghi, I noticed that in your introductory statement you sort of changed the language a bit to emphasize more the accommodative nature of your monetary policy stance. You say you emphasize this accommodative nature and you firmly reiterate your forward guidance. Might this change in language signal that you consider the recent rise in money market rates as unwarranted? Or if not, could you perhaps explain to us what might have prompted that change? A second question is on liquidity operations. Some of your colleagues recently appear to have suggested that it might be difficult to devise an operation that would target funds to the real economy. And I was just wondering where the debate stands on that issue at the moment. Thank you very much.
Thank you. Yes, you're right. We used firmer words for indicating the strengthening of our forward guidance, which basically means that we reiterate our decisiveness to act if needed. And there are two. We think the present market developments are okay, but we think that there are two contingencies that could lead us to act. One is unwarranted tightening of the short-term money markets, and the other one is a worsening of our medium-term outlook for inflation. So that is what basically this firmer language is addressing. On the second point about that, the developments of excess liquidity have attracted a lot of attention. But let me reiterate once again that it's very, very difficult to derive, to infer a stable relationship between the excess liquidity figures and the EONIA rates. Let me give you some figures here. If we compare the December 31st figure, we had an excess liquidity of 274 billion, and the EONIA was 22 basis points. If we take the 6th of January, so 1 week later, 2014 excess liquidity, we have 276 billion of excess liquidity, and EONIA, which is only 9.9 basis points. Now, of course, this one can say it's related to year-end technical developments. But if you look at the somewhat broader comparison, you reach the same outcome, the same conclusion. If you look at the excess liquidity on the 19th of December 2011, you see the excess liquidity is 300 billion. and the Ionia is 30 basis points. Then we move to the 15th of May 2013. The excess liquidity is 303, so roughly the same amount, but the Ionia is only 8 basis points. So it's very, very difficult to draw the conclusion that there is a stable relationship between the two magnitudes. Thank you.
My question was on the conditional LTO, whether you have debated that further in the conclusion.
We have, as usual, we have discussed all the possible instruments just to cope with these two broad contingencies, and our discussion continues and it's been carried on as usual. Thank you.
Brian Blackstone, Wall Street Journal.
Brian Blackstone with the Wall Street Journal. If I could just press you on that last point you made. When you talk about this readiness to act and all available tools, can you give us a sense of what these tools are, whether they're traditional interest rate cuts, deposit rates, the LTROs, quantitative easing, what's in your toolkit? And that if these conditions that you laid out were to be met and more easing was to be required. And my second question is on banking union. How concerned are you about the adequacy of the public backstops for the resolution of any problem banks, or if there are holes in the asset quality review? And if the money's not there, is there a risk that this maybe undermines confidence rather than be a confidence building exercise as you hope? Thank you.
Okay. Well, thank you. On the first point, we have several instruments that we can use, and their choice will depend on what contingency will actually happen. Some of these instruments would address more easily a development in the short-term money markets. Others would be meant to address broader worsening of our medium-term outlook. So I think at this point in time, it's pointless to speculate which instrument we would use. But let me be absolutely clear on a more general point. We have a mandate to maintain price stability in both directions. So for the Governing Council, all eligible instruments that are allowed by the treaty would be eligible. All instruments that would be allowed by the treaty would be eligible. So let me make this point quite clear. On the second question, it's now I'm not sure I understand. Are you referring to the public backstops related to the outcomes of the asset quality review, or are you referring to the SRM? Okay, I'll take your yes as first answer. So now I say both. But on the first point, I'm just asking you a question. What leads you to think that there aren't such backstops in place? There has been a solemn commitment by the leaders, confirmed by the ECOFIN, confirmed by the Eurogroup. So all governments are basically committed to provide these public backstops, which would enter into place according to the established regulations, which means basically that all the list of creditors will have to be bailed in and so on and so forth. So the rules on state aid would have to be complied with. And on this, I think there is an explicit commitment that I frankly have no reason to doubt of. Thank you.
Jeff Black, Bloomberg.
Afternoon, Jeff Black from Bloomberg. President Draghi, given the ongoing weakness in lending that you mentioned in your introductory statement, would you say that the need to undertake the AQR has delayed the recovery in lending because of banks seeing the need to tidy up their balance sheets? And if you do recognize that, then is there anything that you can do to mitigate that, or would you intend to try and mitigate that? And my second question is about the member of the executive board that will eventually take up a position as the vice chair of the supervisory board. Now, you've stressed in the past the need to have separation here. So I'd be interested if you could explain what role that board member will play in governing council debates on monetary policy, if they'll exercise that person's vote, or if they will abstain from activity on the monetary side. Thank you.
Thank you. I will answer first the second question. I will quote from the statute of the ESCB and the statute of the ECB. It does say each member of the governing council shall have one vote. So this is part and parcel of the treaty, cannot be changed. Having said that, we'll certainly make sure, and we are actually making sure already, that there are enough degrees of separation so as to establish absolutely that the two decision sets are being kept separate. So that is what we are doing, separation within the treaty. On the other point is the weakness in lending and whether AQR is actually sort of increased this, or generally speaking, one certainly might have some short-term deleveraging by the banking system in order to be prepared for the AQR. However, one has to counterbalance this with two other considerations. One is the long-term greater health of the banking system. When I'm saying long-term, I'm not saying years. We're talking about at the end of this year, when the AQR will be finished. The banks are actually undertaking corrective action even before, as you yourself suggested, before the AQR is actually taking place. So by the end of this year, we'll certainly have a stronger banking system, and certainly more transparent. And certainly markets will be able to understand better what is in the bank's balance sheets. And that's the second point. One has to counterbalance the short-term implications with the fact that, as you can see, the capital markets have reopened for banks. And here I would like to sort of to draw your attention on one very interesting piece of data. You know that after the Lehman crisis, the spread between corporate issuance, known financial corporate issuance, and financial or banking issuance went up a lot and stayed up for quite a long time. Now our figures show that it's disappeared. I think to me this is a very important signal of some improvement in financial markets. So that's the spread has gone, I think it's gone to zero by and large. So finally, let me make a general consideration. I don't think we want to repeat the mistake made by other countries in not repairing the banking system when it's time to do so. We've seen that an unhealthy banking system slows down transmission of monetary policy, hampers credit, and to have a fragile banking system, I'm not saying we have it, by the way. I'm saying that it's very important to think and address this concern. So it's very important to avoid a credit crunch. That's why we want to do it. And I think so. It's true, your short-term implications are there, may be there, but you want to counterbalance these with all these considerations. And I think in the end, the scale is very much on the side of taking action. Thank you.
Claire Jones, Financial Times.
The fall in core inflation to a record low in December has prompted some calls from some analysts for more action from the ECB straight away. Were the views of analysts shared by any members of the Governing Council today in calling for more action immediately? And second, you mentioned in the answer to one of your questions that all eligible instruments allowed by the treaty would be eligible if necessary. Can you just confirm whether or not that includes outright asset purchases or not?
On the second question, I think the answer is what I've said before. And as I said before, I don't want to go into the specifics. I want to be absolutely clear that we have a mandate which is to ensure price stability in both directions. And the Governing Council is ready to use all the instruments that are allowed by the treaty. On your first question, the point, I mean, we were all aware that the decline in the inflation rate in December was first of all, was expected. And it was caused by a technical adjustment in the statistics of the services inflation in Germany, which basically produced a much flatter seasonal adjustment. And it meant that the December data came out lower than the 0.9. But fortunately, this is a one-off event, so the January data will not be distorted by this. Thank you.
Thank you. Mr. Draghi, after a 3 years crisis, the bond market in Europe seems now to be in better shape, or at least to work more normally, especially in the south of Eurozone. There's still a lot to do, but how do you see this evolution, and what do you expect for the coming month? Thank you.
Well, there are many reasons, some of which we're actually still exploring. But there is no doubt that the financial markets have been gradually easing since July 2012. This is due certainly to the ECB action, but also, equally important, to the action by governments, both in fiscal consolidation, but also in some countries especially, which are, by the way, the ones who are seeing now the greatest benefit, also in undertaking the needed structural reforms. And third, we have to look at what happened since then to the general euro governance. The progress that's been made on the banking union. I know that many commentaries always look at the glass as half empty, but it's not true. I mean, if you just have some historical perspective, and you look how the euro area governance was a year and a half, 2 years ago, and you compare what it is today, there has been an extraordinary, very significant step forward. I think these three factors explain some of the improvements. But also, frankly, there are also other factors that will still have to be analyzed. Thank you.
Eva Taylor, Reuters.
President Draghi, you said recently in an interview that we must take care not to get stuck in a period of inflation below 1%, and thereby slipping into a danger zone. And in the introductory statement, you noted that inflation will be staying around current levels for the coming months. How long can you stand being in this period, or in this below 1%, basically, before you have to do something? My second question is about money markets. You just talked about the nexus between excess liquidity and money market rates. And we're seeing that some money market rates are now at a higher level than they were last summer when you say they were unwarranted. Could you maybe explain a little bit what's driving them at the moment? Thank you.
Thank you. On the first point, as I said, inflationary pressures are going to remain subdued for quite now. They're projected to be subdued, to stay subdued on the low level of 2% for at least 2 years. But we have to look at that from the medium term. And this is so far, this is quite in line with our baseline scenario. We will act when we will have reason to think that our medium-term assessment for inflation is changing for the worse. And as I said before, we stand ready to act, and we stand ready to use all the needed instruments that are allowed by the treaty. So we have our mandate, we are acting within our mandate, we have to use the instruments that are allowed by the treaty. So on the second point, money market rates, short-term money market rates depend on a variety of factors. Our forward guidance, strengthened by the decision that we took in November, has produced quite a successful, I would say, stabilization of the interest rates curves in the short term. We have, and certainly has reduced uncertainty about the interest rates, volatility of interest rates, and also uncertainty about monetary policy action. We have clarified our reaction function. But we have to keep in mind that there are all kinds of influences on these rates, some of which have to do with our own Eurozone economy, and some of which have to do with external factors. Our view is that after the forward guidance has been issued and has been strengthened by our November decision, the factors that have to do with our own economies are now predominant. In other words, to some extent, the euro area is fairly insulated to some extent from outer developments. And I think that's what we are seeing now. And the overall situation is very different from what it was in July.
August, you mentioned.
Yeah, when you said that, yeah. Thank you.
Jeff Catmore, CNBC.
Thank you very much for the opportunity to ask a question. And it would be remiss of us not to also wish you and the Governing Council a very happy new year.
Thank you.
In return. So let us make sure we do that. My question relates to the bond markets once again. This week we've seen the Irish come back to the market and the refunding exercise be very successful. So does that, do you think, stand up some of the comments that we've heard from Commission politicians who've said that we can now declare victory on the Eurozone crisis, or given some of the data points that we've discussed, like the 12% unemployment for the Eurozone, the high youth unemployment, and so on and so forth, is it premature for us to describe this crisis as now being over? And can we actually, declare victory, as some have said, politicians, obviously, who are trying to reach out to a broad platform? But your views on this would be very welcome, sir.
Thank you. I'd be very cautious about saying that. Be very, very cautious. Unemployment stands at 12 and more %. The only positive news about unemployment is that we see this rate, this high, unacceptably high unemployment rate stabilizing. In other words, it's not going up each and every month, but it's still more than 12%. The recovery is there, but it's weak, it's modest. And as I said many times, it's fragile, meaning that there are several risks from financial to economic to geopolitical to political risks that could undermine easily this recovery. It's a recovery that, fortunately, from being based exclusively on export growth, is now gradually, very gradually, extending into domestic demand. And we can see that. But it's still, I would say, premature to declare any victory. And I think that's why we are using, as someone observed at the very beginning, why we're using an even firmer language for our forward guidance. So I think if you look at the drivers of this recovery are, on one hand, export growth, and we think that global demand may continue to be what it is, and if anything, a little stronger. On the domestic demand side, let's ask what are the factors that actually are helping this recovery to spread on the domestic demand side. One is certainly our very accommodative monetary policy stance, which finally now, as I've said many, many times, is finding its way through the economy. That is one thing that's happening. There's a second effect which relates to what you said about the bond markets, confidence. Confidence is gradually coming back. There is also some less of a fiscal drag than there was last year, and that's a third effect. So, and then finally, there is also an effect due exactly to the very low price, well, to a very low inflation rate, which is supporting real disposable income. Now, if you examine these four factors, you see how easy it is to change each one of them into the opposite. I mean, the monetary policy stance certainly not. It's a policy decision. But the confidence is returned. But, I mean, 6 months ago, we wouldn't have said that. Even 3 months ago, we wouldn't have been that explicit. So we want to see confidence staying for a relatively long time before we can say we can declare victory. And so I would say things are slightly better. Our baseline scenario is being confirmed. Thank you.
Jean-Philippe Lacour, Les Échos.
Mr. Draghi, to make it very clearly, would you say today that deflation risks are not higher than they were on November when the ECB promptly decided to cut rates after the very low inflation rate of October? And secondly, the ECB issued a statement on SEPA migration. And when we read between the lines, it seems that the ECB is a kind upset about the possibility to delay the end of migration. So could you maybe more elaborate on this? Thank you.
Thank you. On the first question, I really kind of answered before. The data point has come out in December. It was essentially due to this technical, I think someone called it quirk, and in the statistics of the services inflation in Germany. On the second question is, well, I'm not sure what between the lines means. I would say it is the Commission's initiative, and it's the Commission view. Thank you.
Okay. Sebastian Joost, Die Welt.
Thank you, Mr. President. First, short question. Is there any news regarding the protocols of the Governing Council meetings? And second question, to come back to the SEPA migration issue, could you elaborate a little more why the Eurosystem seems obviously to be skeptical about postponing the deadline for the migration? Is it just not necessary from your point of view, or is it a sort of problematic or even dangerous? Perhaps you can say a little more about that. Thank you.
Thank you. On the second question, what we were observing of recent is that finally the migration was picking up, and I can give you some figures. First of all, there have been significant efforts by the majority of the stakeholders, all stakeholders in the euro area. And for example, November migration figures for the euro area show a significant increase in SEPA direct debits to 26% of total transactions, more than double the October, where they had increased by 11.5%, and almost 4 times the September figure, when it was only 7%. So we, based on the feedback we get from the industry and from the markets, we do expect this growth rate to continue as we speak. As of credit transfers, 64% of transactions in November were already SEPA compliant, and they were up from 60% in October. So that's why, in a sense, we want to see this migration completed. We think it's of benefit for the consumers, first and foremost, and in a sense, indirectly also for the banks. On the minutes, we still are reflecting on it. The executive board will present soon a first proposal, which I kind of used the wrong word, not minutes. I think accounts, you said protocols, it's just, and we will discuss it. As I've said sometimes, many times in a sense, it's not an easy issue. It's complicated by the fact that the ECB wants to be, we think we are transparent already, but we want to be even more transparent, giving some more richer information about our deliberations, about our discussion. At the same time, we have to keep in mind that we are not a one-country environment. And this implies that we have to be the jealous guardians of the independence of our governing council members. Thank you.
David Jolin, New York Times.
Hi there, David Jolly from the New York Times. Jack Lew, the U.S. Treasury Secretary, was just in Paris, Berlin, and Lisbon this week. I attended his press conference in Paris, and he said that the United States was looking for a growth agenda that has to be rooted in investment and demand, and it was clear that some countries have more capacity to stimulate growth and demand than others do. I have a suspicion he was talking about Germany. Is that a view shared by the ECB, that there are countries here, maybe some with the current account surpluses, that need to step up and stimulate demand?
Well, let me make just 2 points on this. In a speech I gave in Berlin about a month ago, I quoted your president, Abraham Lincoln. He famously said, "You cannot make the weak stronger by making the strong weaker." So you want to promote growth, but you are not doing it weakening the country that is best performing in the euro area. All the euro area members benefit from this performance. If there are, as there are, structural investments, infrastructure investments to be done, they ought to be carried out, regardless, in a sense, of what is the consequence. They ought to be carried out. So the policy advice is really continue your successful performance and take care of the weaknesses in investments where it's needed. But I never understood very well the idea that making Germany weaker, you would benefit other countries in the Eurozone, or undermining the fundamentals upon which the strength is based. One would make the other countries stronger. Thank you.
Klaus-Rainer Jackisch, Hessischer Rundfunk.
You have given us an account about the effectivity of the measurements being taken.
I'm sorry, activity of?
About the effectivity of the activities, not about the effectivity, about the measures you've taken within this crisis. Could you give us, please, also an outlook and your account where you see the main risks in the forthcoming months that could undermine this effectivity? And secondly, could
undermine this creativity?
No, this effectivity. I mean, you've shown us how effective.
Effectiveness.
You've shown us how effective the measures were. Could you just tell us, please, where you see the main risks that could undermine this way? And secondly, please, just to clarify, in the last months, you've always told us that the ECB Council currently sees no deflationary pressures. Now we see rather negative outlook for the coming months. Is this still the stance the ECB Council has? Thank you.
You're welcome. Now, there are, as I said in the introductory statement, and as unfortunately I've been saying now for months, there are downside risks to the economic recovery. And the downside risks stem from all the uncertainties, financial, political, commodity prices, all the uncertainties that could undermine the main factors driving the recovery. Loss of confidence, crisis, even political crisis. So these could all, in a sense, undermine the success of this which isn't there yet, as I've just said, of this very modest recovery. On the inflation side, I should say this is our baseline scenario. We don't see right now, we don't see deflation. But if you have low inflation for a very protracted period of time, it's quite clear that we should be extremely aware of the potential downside risks. Right now we see limited upside risks and limited downside risks for the inflation path. And let me also add that when we define inflation as a broad-based, self-fulfilling, self-feeding fall in prices, we don't see that in the euro area. And even when we look at the individual countries, we may see actually negative inflation rates in one or two countries. But then we should also ask the question how much of this is due to the necessary rebalancing of an economy that had lost competitiveness and had gone into a financial and budgetary crisis. And how much is it due to actual true deflation? So by and large, we don't see a deflation in the Japanese sense of the 90s. We also ask ourselves, and perhaps we've gone through this on another occasion, but we also ask ourselves, how are we close to Japan? And the answer we gave ourselves is no, we are not. We are not in a Japanese scenario for a variety of reasons, the first one of which is the most important, is that the ECB has taken decisive action at a very early stage of this crisis. But the second also is that the condition of the balance sheets of the banking sector and the corporate sector is not as bad as it was in the 90s there. The third reason is that we are now proceeding fast to make the AQR, namely to repair, which would lead to repair our banking system. And the final reason is that if we look back how long-term inflation expectations were actually behaving in Japan at that time, we would find out that they were actually not firmly anchored. That's why it's so important that our inflation expectations remain firmly anchored, because they tell people that in a certain amount of time, over the medium term, the inflation will go back to our objective, namely close but below 2%. Thank you.
Kodiakolor, SVT.
Hello, I'm Kodiakolor from Swedish television. I'm wondering, can the ECB ever run out of money?
Well, technically, no. We cannot run out of money. So we have ample resources for coping with all our emergencies. So I think this is the only answer I can give you.
Mark Schwarz, Börsenzeitung.
Mark Schwarz, Börsenzeitung, thank you. My first question is on inflation. You said that the small decrease in December was broadly as expected, and that you expect annual inflation rates to remain at around current levels. Does this also include that you would not be surprised if annual inflation...
No, I'm sorry. Does it also include that you would not?
That you would not be surprised if annual inflation rates fall a little bit further in coming months, as some economists expect? Or would you expect annual inflation rates to get up a little bit, at least, in in the coming month. Do you understand? So basically the question is whether if annual inflation rates decreases further, does this mean that it would change your medium-term inflation projections?
Yeah.
And the second question, if I may, is on your relationship with the Germans and the German public, or the ECB and the Germans. In an interview, you said that in Germany there was a perverse angst to that things were turning back. I just wanted to know, do you really think that this was helpful to increase the understanding and the support in Germany for the ECB policy? Thank you.
Yes, thank you. Thank you. Now, first, let me answer the first question. We have baseline scenario, which was given in the last macroeconomic projections by the ECB staff, and that's where the inflation figures for the next 2 years are. We don't expect anything different other than our baseline scenarios. Otherwise, you wouldn't call it a baseline scenario. On the other point is, let me say a couple of things. First of all, if I can find the actual definition of perverse in English, I'd be very glad. But as usual, anyway, there is a difference between perverse and perverted, and I think there was a misunderstanding there. Second point, and more serious, there were two issues in this interview, and let me read this. Are you saying that the euro crisis is over? That's the question. The answer is no. But the fears felt by some sectors of the public in Germany have not been confirmed. What haven't we been accused of? When we offered European banks additional liquidity 2 years ago, it was said there would be a high rate of inflation. Nothing has happened. When I made my comment in London, there was talk of a violation of the central bank's mandate. But we had made clear from the beginning that we are moving within our mandate. Each time it was said, for goodness sake, this Italian is ruining Germany. There was this perverse angst, not perverted angst, that things were turning bad, but the opposite has happened. Inflation is low and uncertainty reduced. This is the sentence that I pronounced. Now so the angst is referred to inflation angst. It's been also commented there is another angst which actually is very serious and very real, and we should all be concerned, not only in the euro area but in most developed countries, and that's the angst of people who are preparing for their old age. That's the angst of people who have their pension plans being reduced in capital value by the very low level of interest rates. That's a different thing. That's a serious problem, which the low inflation and the low interest rates carry with themselves. And so we're also thinking about this. We're very aware of this problem. And that's a very reasonable angst. And we are confident that as the recovery takes place, and as the recovery will get firmer and firmer, we will see better rates of return on the investments of the pension plans and insurance plans. And I also commented that these rates of returns have little to do with our short-term rates. So even though they are depicted, the ECB is depicted as the institution that actually are keeping rates low, we're not talking about the same rates. The rates of the pension plans are long-term rates. We are talking about short-term rates in our policy rates. So the two things are different. So thanks, Christine. Now, the definition of perverse in English is persistent in error, different from what is reasonable. Now, that's one of the many definitions, of course, but this is the one I was referring to. Persistent in error, different from what is reasonable. Is it okay? Thank you.
Philipp Plickert, FAZ.
Mr. Draghi, allow me to come back on the topic of SEPA migration. You've given us some average numbers for the euro area on how many percent of transfers are made in accordance with the SEPA standards now or in October, November. But there are differences between countries, BRM, and how could we explain that some countries are lagging behind so much, especially Germany? Would you also say there's a perverted
please.
reluctance to adopt the
No
SEPA
more.
here, or reluctance in
more.
error to? Why is it that Germany especially is coming so late in SEPA migration?
Well, I don't want to comment really on specific countries. I can give you the names of the leaders. The leaders are Finland, Luxembourg, Slovenia, and Slovakia, with migration rates close to 100% for credit transfers. Finland and Slovenia are also close to 100% for direct debits. So I think in everywhere, even in Germany, if we focus on growth rates, the migration is actually taking momentum, gaining momentum. In a sense, it's quite understandable that the larger and the more complex banking systems take longer to achieve what is an amazing migration, so to a single European system. So I'm not, certainly what I can see now is that we see a general significant effort by all the stakeholders, so banks, corporates, and so on, in the euro area. And as I said, larger and more complex systems will naturally take longer. Thank you.
Gentleman from Ansa, from Mr. Conti.
Mr. Draghi, Domenico Conti of ANSA. I'd like to ask you a little more details about the asset quality review. I'd like to know if there's consensus on the treatment of government bonds. Just if you can give us a little more details on this. My understanding is that they would be considered as having no risk in the asset quality review. If you could be just a little more specific on this. And another question regards whether you have reached agreement on any date, future date for the publication of the details of the requirements for banks in view of the asset quality review. Thank you.
Yeah, on the second point, we will come out with the second batch of information at the end of this month, where we'll say more about the asset quality review, we'll say more about the stress tests, and so that is the deadline that we've given ourselves. On the first point, I'm afraid there is a certain amount of confusion here. The government bonds are going to be treated in the asset quality review exactly like the Basel Committee is saying. So the government bonds are, in the Basel Committee regulation framework, are riskless. And that is one thing. Now, like all assets of the banks, they will be subject to stress tests. But they are risk-free. A different issue is what happens to the banking regulation. How will the future banking regulation will treat the government bonds? And that's an entirely different issue which we don't cope with here, but the natural place where to discuss these issues is the Basel Committee, because any change to the treatment to government bonds will have to be agreed at global level. Thank you.
Thank you very much. We'll take the last question from the gentleman over there. Thank you.
Thank you very much. Nobusunaga from GG Press, Japanese news agency. I'm sorry if I missed your comments on this. Were there any board members who were in favor of rate cut at this meeting, or was the decision to hold the rate unanimous? Thank you.
Thank you. As I said before, we had an extensive discussion on the state of the economy. We asked ourselves questions about what, like one question I just got, really, what sort of risks could undermine our baseline scenario? could this modest recovery all of a sudden weaken? What would cause our medium-term assessment for inflation worsen? And when I say worsen, at this point in time, I mean going down. Are the risks for inflation bigger in one direction or in another? I said they're limited in both sides, and in the introductory statement I said it's broadly balanced. And then we said, we asked ourselves, what is an unwanted tightening on the short money markets, which could then translate itself into being a threat for the recovery? This sort of questions have been discussed. And then, of course, we discussed all instruments that would be used in case such contingencies were to materialize. Thank you.
Thank you very much.
Thank you.